Ali, the technology sector has surprised many investors with its returns year to date. What has driven this?
It's certainly been a strong year so far for tech. I think it's worth remembering where we started the year though. 2022 was a very challenging year for tech. We had record decade-high inflation. We had a very aggressive Fed trying to tame that inflation, which compressed or put downward pressure on multiples for growth assets, many of which feature in our portfolio. We were also lapping some of the COVID strength last year. So we saw companies who had hired too many people or spent too much on tech pull back. We saw layoffs in the tech sector. So sentiment at the end of last year on tech was very, very negative. Added to that, we had the risk of a recession, and certainly a sense that maybe valuations had come down a lot, but actually estimates were going to fall even further. So we came into the year, I would say, balanced on a wider range of potential outcomes, both upside and downside. And what's transpired this year is that the upside outcomes have basically dominated the downside ones. So we haven't had a recession. The Fed has, to some degree, or certainly to a reasonable degree, got inflation under control. So that's become less of a concern. The range of outcomes on rates has narrowed somewhat, which is good news if you're a long duration tech investor like we are. So when we put all that together, the backdrop has got easier. On top of that, we have had the emergence of a very powerful new technology theme in the form of AI, which has been a large part in driving tech market returns this year and our portfolio returns.
So given the rise we've seen, have actual earnings from the company supported this rise in valuations?
Earnings have been quite good. They've been better for tech than for the rest of the market, or the revisions have been stronger for tech than the rest of the market. Most of the market returns this year have been driven by an expansion in valuation multiples rather than earnings, but that's on the back of a compression in multiples last year. So that again, we have to think at the starting point. We've seen big upgrades for some of the mega cap internet companies, which again have very easy comparisons from last year when things were more challenging. And we've seen the impact of those layoffs we saw in the second half of last year come through. So companies in the tech sector have found a bit more cost discipline than perhaps they've been known for historically, and that's translated into strong earnings and free cash flow growth this year for many companies in the portfolio.
The rise in the broader US market has seen the media refer to the Magnificent Seven stocks, which have accounted for a large proportion of the returns. Now there's a number of tech stocks within that. How do you manage the risk of having too much in one stock or too little in one stock?
I think that the risk you're referring to is concentration risk, which is something that we've called out in our annual report for the last few years and something we discuss with our board at virtually every board meeting for the trust. And the challenge we have is that there is a small number, although they are very large in size, of extraordinary companies that are natural monopolies and for which there is no equivalent. There isn't really another Apple, given their dominance of the smartphone profit pool. So when we think about those companies, we are balancing the absolute risk of how much we have in a single stock with the relative risk of being underweight what our benchmark has in them. And we've effectively been between 10 and 15% underweight mega cap as a group over the last few years. And that has provided a relative headwind to, or certainly a headwind to relative performance, while our our large absolute positions have been very good for absolute returns. So we spend a lot of time thinking about that, and the conclusion we've come to is that we don't think it is in our shareholders' interests for us to go much above 10% in any of them. We are able to go up to a benchmark weighting, up to 15% if we think that is appropriate, but we in practice have not really gone much beyond 10. As at that point we start to think the concentration risk or the single stock risk outweighs the relative risk of being underweight.
Okay, so given that concentration risk you've talked about, how has the trust performed this year?
So absolute returns this year for the trust have been quite strong, and that's largely been a function of the fact that we've been very bullish about AI for a long time, and maybe 2/3 of the portfolio as we see it is exposed to AI, so that's driven the strong absolute performance. We've underperformed the benchmark by a bit. A lot of that difference is accounted for by the fact that the mega caps, as you mentioned, have been really, really strong. But we remain pretty constructive on the outlook from here, even though we've had this big move, as I say, partly taking into account the fact that last year was very bad, so the starting point was quite low.
And finally, given where we are now and the returns we've seen this year, what's your outlook for the tech sector?
We are still very excited about the AI opportunity in particular. We think that we're very early there, and this is a transformational opportunity for tech to be involved with reimagining industries, attracting new profit pools, and really exciting potential for disruption over the next 5 to 10, 15 years even. So that keeps us very excited. Nearer term, Rates are starting to move a bit higher, which can pressure valuation multiples as we saw last year. So that maybe gives us a little pause in the near term, and the path higher is never linear, so there can be setbacks on the way. But we still think that the right approach is to manage the trust with a diversified portfolio of growth companies covering between 6 and 8 core technology themes, making sure that we're not missing out on anything. And we pay a modest premium to the index for that, but we get a lot more growth. And we think that over the medium term is going to provide excellent returns on a risk-adjusted basis in particular.